there's no bullion around. The demand is huge, and there's just not a lot of stock around, and it's cleared out. And with gold, we're seeing central banks taking out physical gold out of the market. We've seen deliveries on COMEX. I mean, there was, I think last Friday, there was an extraordinary figure, something like over 19,000 contracts stood for delivery. This never happened before. And the question now, of course, is where do we go from here?
Hi, I'm Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special for October 4th through October 11th, 2022. This week we feature a very special silver buffalo at only $4 over spot while this shipment lasts. These 1-ounce silver rounds are made by Bullion in Bulgaria, a mint distinguishing themselves by raising the bar not only on purity and quality, but on artistic merit. So you'll see that these are buffalo rounds reimagined, with 4 nines fine purity instead of the traditional 3, as well as a new portrait on the obverse and dueling bison on the reverse. They come in tubes of 20 and what Bullion calls master boxes of 400. Again, these rounds are available at $4 over spot for a very limited time. Our number for all orders is 1-888-81-LIBERTY. It's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today, one of our viewers' favorite guests, Alasdair Macleod, the head of research at goldmoney.com. Alasdair, thank you so much for joining us today.
That's my pleasure, Elijah.
Well, no, we're always impressed by the flood of viewers' questions we get ahead of interviews with you. And we had to have you on today because we have seen over the last week or two great amount of volatility in the pound, the UK's currency. And this has kind of rocked the markets. We've seen a whole lot of volatility in all the markets, actually. But I wanted to get your perspective. What are the ramifications of these up and down wild swings in the pound sterling?
I think the thing that really shocked the establishment in Britain was that Liz Truss and her Chancellor Kwarteng are really sort of more or less doing a Hayekian approach to the budget. They are trying to return as much as possible to free markets, which means less regulation, lower taxes, and all the rest of it. The only thing that was missing, which I think did impact markets, was the lack of any concrete plans to cut public spending. Because if you're going to follow this route, and it's the right route to follow, then you need to reduce the size of the state in the economy. And that was lacking. I think, I mean, in the practical sense, it's far easier, I think, to come out with the tax cuts than it is to come out with planned reductions in government spending. That requires a process of partly consultation, partly finding out what economies can be made, putting together a plan for reducing regulation, putting together a plan for downsizing a lot of government departments, because we've got a lot of bureaucracy. I mean, you'll have the same in America in your government departments. So it's all those things. I mean, we have to bear in mind that in markets, virtually everybody, apart from a few mavericks like you and me, are Keynesians, and they see a sort of, if you like, an economy which really requires government intervention. The difference with Liz Truss's approach is that no, it is actually far better to let markets sort themselves out. Now, the problem, I think one of the problems with this is that if you do that against a background of very heavy market intervention, which is what our government does, what every other government does, then inevitably lots and lots of people are going to get hurt. And they're going to get hurt as a deliberate act of policy. rather than a collapse of the status quo. Now, without this, there's no doubt we would be heading for a collapse of the status quo. So that would happen anyway. But it takes an awful lot of political guts, if you like, to say, well, we're not going to wait until the thing collapses. What we want to do is we want to break ranks with everybody, all the other nations who are just doing this business of, taxing as much as possible and, running huge, great budget deficits on top of that, because of all the obligations that government has, and whether it's COVID, whether it's subsidizing energy prices, all these things. We're trying to break away from that, and I think, it's definitely the right policy. With a bit of luck, and I don't think this is going to happen incidentally, but with a bit of luck, by moving in this direction before anyone else does, then the British economy should recover its poise, if I can put it that way. I'm not talking about growth. Growth is the wrong word completely. Its poise, its progress, its efficiency. The economy could become a lot better ahead of everybody else's. And I think that's the important thing. I'm not saying that we're in a competition with other economies. That would be entirely wrong. What we're trying to do is we're trying to make the best of our economic resources, and the way you do that basically is government has to butt out, and that's pretty much what Truss was trying to achieve. But as to the markets, it came at a slightly unfortunate time because we had a dollar which was rising on the back of collapsing euro, collapsing sterling, collapsing Chinese yuan, collapsing Japanese yen. Everybody was getting out of everything, and even gold and silver, and they were going into what they perceive to be safety, which the Keynesians say is cash dollars. That's their idea of safety. So, this actually happened at a time when this sort of bombshell, if you like, from the mini budget hit the markets. It undermined the gilt market. And it created a crisis amongst the institutions, particularly the pension funds, who were leveraging up the returns on the gilt market in an effort to make up the shortfall on their obligations. And they were gearing themselves up through repos, through interest rate swaps, and so on and so forth, up to 6 or 7 times. Now, this to me is actually not what pension funds should be about. So what we've done is we've sort of, by mistake, if you like, exposed this sort of craziness in the markets, which is the direct result of the suppression of interest rates over recent decades. And so the impact on sterling was very, very heavy. But interestingly, the one investment which actually did incredibly well were British gilt index linked. If you went for a long maturity index linker, you could have bought it, and I was looking at one in particular, at just over 60. This is, 60 per 100, as it were. And they've now gone up to over 130. And that in literally 3 days. How about that for a return? That was absolutely amazing. It was almost as good as buying the ruble at the bottom, if you like. So anyway, that's really what's happened. And I think, since then, sterling has bounced from $1.05, something like that. It's now currently trading, I think, around about $1.14. Again, helped by if you like, the backwash out of the dollar, because everybody is long dollar, short of everything else. And you can see that everything, absolutely everything now is rising on a very, very sharp fall in the dollar's trade-weighted index, including gold and silver, and silver in particular. Well, both gold and silver. There's no bullion around. You'll know from your business the availability of silver coins, gold coins, small silver bars, and so on. The information I have from virtually everybody is, in your line of business, is that there's, the demand is huge, and there's just not a lot of stock around, and it's cleared out. And with gold, we're seeing central banks taking out, taking out physical gold out of the market. We've seen deliveries on COMEX. I mean, there was, I think last Friday, there was an extraordinary figure, something like over 19,000 contracts stood for delivery. I mean, this has never happened before. I think that's a record, actually. I haven't seen anything as high as that before. So what we've got, I think, is markets which have just they just got to an extreme position. You've had this switch round. And the question now, of course, is where do we go from here? And if that's your next question, I'll try and offer some views.
Definitely. And if we could focus again on the pound and also what we're seeing in the euro right now, we do have a viewer's question, which is exactly this. Where do we go from here, and how do people protect themselves, especially those living either in the UK or in the EU? The question is, do you think that Britons and Europeans should move their cash when faced with the falling pound and euro?
To my mind, the problem is broader than just looking at, shifting from one currency to another, or even shifting, let's say, from longer maturities to shorter maturities, or lightening up your equities. The problem basically is that we have a failing fiat currency system. The whole system is failing. I'll just run off a few points. If you look at the commercial banks, they are horribly over-leveraged, and many of them are trading at very substantial discounts to their book value, which actually tells you that either they're very cheap, or if the discounts are that great, then they are insolvent and probably bust. So when you see big banks like Credit Suisse, which of course has been in the news, Deutsche Bank, and a few others in Europe in particular, and in this country, Barclays, whose share prices are at such a substantial discount to book value. I mean, I'm talking about a discount of over 60%. This is not good. This is really not good. Look at the balance sheets of the central banks. I mean, they've been accumulating government bonds under quantitative easing, and they're underwater on those because the prices of those bonds have fallen very substantially. The central banks themselves need recapitalizing. The Bank of England can get away with it simply because, very sensibly, they did a deal with the Treasury. They said, okay, we remit all our profits on our gilts, which we buy under QE, to and the dividends to the Treasury. But in return, what we want is the Treasury to guarantee that we make no losses on the bonds we buy under QE. So the Bank of England balance sheet doesn't show all these bonds. It just shows the special purpose vehicle valued at par. Boom, that's it. And of course, guaranteed by the Treasury, the auditors are quite happy to accept that. So that was very clever. But the ECB is in a different position. They don't have a government to turn to. Their shareholders are all the national central banks, like Deutsche Bank, Bundesbank, the Bank of Spain, Bank of France, and all the rest of them. And they're all in the same problem. They've all got the same problem as well. So looking at it from the point of view of, say, the Bundesbank, they need to recapitalize. Now, it's actually a very simple thing to recapitalize a central bank, because all you do is you lend the money to the government and the government reapplies it to your balance sheet. But instead of it arriving on your balance sheet as a deposit, it arrives in your balance sheet as shareholders' capital. So you can recapitalize a central bank very, very easily. But you need legislation to do it. And in the case of the Bundesbank, you're going to have people on the floor of the Bundestag saying, well, hold on a minute, you're owed 1.2 trillion euros on the Target 2 system. Tell me, what's all that about? So you can see how suddenly this is all running into the long grass, and there's absolutely no way that this is going to be an easy job of recapitalizing the euro system. And with major Eurozone GSIBs in substantial financial difficulty, let's not mince words, I think that the whole of the Eurozone system is likely to collapse, and more particularly because they've got this crazy thing of, sort of banning Russian energy when the one thing they need is Russian energy. I mean, look, I love the Ukrainians and all the rest of it, but the fact of the matter is, I'm on Kissinger's side on this one. I mean, he's made it quite clear, and he's absolutely right, that what you've got to do is you've got to talk to the Russians. You have got to reach an accommodation. And if Europe doesn't do that, then it is in deep, deep economic trouble. That is apart from the fact, and it is a fact, that this whole financial system, from the currency through the central banks to the commercial banks, is a mess. So that, I think, is very, very bad news. London is not helped in this at all because the commercial bank clearing system, Eurozone clearing system, is all in London. So we've got all the counterparty risk here. And we've also got the counterparty risk of the Japanese system. And the Japanese system is equally highly leveraged. At least they can recapitalize the central bank. But when you have ratios of assets to equities of over 20 times, this is just bizarre. I mean, that's where we've got to. So the whole system, which I suppose could have just held together if interest rates remained at zero and negative, and maybe looked like they were going to go even a bit more negative. The whole of the banking system, financial system, could well have sort of, muddled along a little longer, but that has now changed. We have rising interest rates. We have a completely different environment. Interest rates are going to continue to rise. I know that markets are saying, oh, well, it's not as bad as we thought yesterday. Interest rates are going to continue to rise. I mean, you've got consumer price inflation logged at over 10%, certainly in this country, also in Europe. I don't think you're far behind. You're probably at 10. I don't know. But to have, to have interest rates set by the central banks at round about sort of 2 to 3% is completely wrong. It should be multiples higher. So you can see that the pressure for higher interest rates is not going to go away. And this means that interest rates will rise to the point where the system starts falling over. And I think where it falls over first is probably the Eurozone, Japan, Britain. America is better capitalized. Its banks are far better capitalized. I mean, I reckon that the average asset to equity ratio is in the region of about 10 to 11 times. I mean, there's variation from that. But that is a lot healthier than anywhere else. And funnily enough, it's in line with China, whose banks are also healthy on that measure. China's got other problems. We won't go there. But it's, the problem is that it's all very well having your own banking system, more conservatively set up than anybody else's. But if Eurozone banks start falling over, if the London clearing market starts having difficulties, then I'm sorry, there's nowhere to hide from it. I mean, not even in the wonderful JP Morgan and Citibanks and all the rest of it, because they are exposed to it and there's nothing they can do about it, really. I mean, so, but to get back to the basic point, do you really want to have everything in this fiat currency system, which is undoubtedly going to fall over? And I'll tell you a bit more about how it's likely to fall over, if you like, in a moment, but it's undoubtedly going to fall over. I mean, the answer basically is no, you should not. What you should be looking at is real money. And legally, real money is only physical gold, physical silver for smaller change, and also physical copper in coinage. Basically, physical gold. That is the only escape. Not ETFs, not paper gold, but physical bullion and coin. That's the only way to get out of this horrid mess. And I think half measures will not save you.
We have another viewer's question here about how really what we're seeing right now is a currency crisis, and it's across the board with all currencies right now. the question is, have we ever seen this before when it's not just one currency, but all currencies at the same time falling in value and possibly in the future going to suffer hyperinflation?
The answer is no, we haven't seen this before, for the very simple reason that before the end of Bretton Woods, through the dollar, currencies were tied to gold. And so while there was, if you like, rising prices, they rose very, very gently because people had more faith in the dollar being exchangeable for gold. It wasn't that exchangeable. I mean, they reduced this and reduced this and reduced this. So the whole thing is a bit of a confidence trick, let's face it. So we've never seen this before. We've never seen a situation where all the currencies are tied to one fiat currency. That is the situation today. One fiat currency falls over, all the rest fall over. And it's, I mean, I'm talking about the major currencies, but I mean, anyone who is tied to the dollar is vulnerable to this. And that's basically what's going to happen. I've described why the Eurozone, I mean, the euro, I think, does not have long to live. We have, obviously, the yen. You've got huge, great problems there because they can't take higher interest rates. They're sitting on the 10-year JGB. They're sitting on the yield there, refusing to let it go over 0.25%. I mean, in this day and age, how ridiculous. That's, that is going to get broken. I mean, no doubt about it. And we've got sterling, and we saw sterling's volatility on, I mean, I think the one thing that sterling's volatility confirms to us is that it is seen in the markets, if you like, as a sort of poor man's Anglo-Saxon dollar equivalent. We've got exactly the same problems, but to a larger extent, we've got a far more volatile currency. Where the dollar goes, we will go. So all these major currencies really do have a huge problem. And I can see the day rapidly coming when they won't exist anymore. Now, that's a very, very serious thing to say. But unless you're prepared to let interest rates rise to the level whereby a depositor gets his time preference, if you like. In other words, the interest compensation has to be sufficient for him to retain his deposits. If you don't do that, then the currency goes down to zero. I mean, that is inevitable. It's the same situation that has faced every hyperinflation, which has all been with fiat currencies. And I think some 70 of them or so in history are known to have occurred. Same happens every time. We're seeing exactly the same thing happening. And the other thing about prices, I mean, if you look at energy prices, energy is fundamental to everything we do. Food is fundamental to everything we do. And I suspect that this winter is going to be extremely tough for a lot of families who cannot afford food because their currency is being devalued. And not only is their currency devalued, but people will be losing faith in the currency, either in the foreign exchanges or domestically, and at some stage both. And as the purchasing power collapses, it'll be the elderly, the poor, who basically suffer most from this. And this is not going to be pleasant, Elijah. It really is not.
Now, we have been seeing an increase in the currency supply a dramatic increase in the currency supply really since the 2008 crisis. And we have a viewer here who would like you to explain a little bit more how inflation works, because it seems like we saw a dramatic increase right after 2008, but we didn't see a whole lot of inflation just until, in the last year or two. So why were the policymakers able to contain inflation for those, 12 years there, but haven't been able to now?
I think there are two answers to this question. I mean, the first and obvious one is that the rise in prices has not been reflected properly in the official CPI numbers. I mean, if you look at shadow stats, for example, and I think you've had John Williams on your show, certainly with Dunnigan. I think he's interviewed him in the past. I mean, he's shown that consistently the loss of purchasing power of the dollar has been considerably greater than the sort of 2%, 2.4%, 1.6%, whatever was being logged, if you like, on the CPI. I think that's the first answer. The second answer is that the idea that the quantity theory of money is the only driver of the relationship between the purchasing power of a currency between a currency and its purchasing power is actually incorrect. There is another driver, and that is public confidence. When you have gold, when you're backed by gold, then the public confidence bit doesn't matter so much. So long as you have, as long as the public are confident that the gold backing is there and it is available to them. Under those circumstances, you find that the purchasing power of your currency holds up, even though the quantity is expanded. I'll give you an example from 1934, when the dollar was devalued from 20.67 down to $35 an ounce. From that date, the expansion of the quantity of bank credit and currency was very, very substantial. Yet, if you look at the price of oil from 1950 onwards, it remained at 2.69, I think it was $2.69 a barrel from 1950 through to into the 60s, into the late 60s and into the early 70s. So you can see that under those circumstances, there was, if you like, a confidence in the dollar, which held up its purchasing power, even though the quantity had increased quite significantly. Now, the difference came really with the end of Bretton Woods. And as we now know, in the 70s, the dollar lost purchasing power very, very rapidly because gold, which is real money, not currency, legally it is money, went from $35 at one stage to $850, I remember, on one fix. Then after that, you had a situation where the amount of currency in circulation was expanded between 1980 and the year 2000. But gold was going down and down and down. Now, to some extent, there was a suppression element in that. There was also the unwinding of bullishness. There was also a view that far from these sort of fiat paper currencies moving towards an eventual destruction, it was clear that what the dollar was doing, or what the American authorities were doing, was they were using the dollar to expanding the quantity to lower the price of commodities by expanding futures markets, by to soak up demand. And this certainly affected gold and silver. And as well as that, you had the dollar really getting its hegemony act together, and everybody had to have dollars. So there was a demand for dollars, basically, to replace gold. So once we got out of that phase, it sort of continued, I suppose. But in particular, I think that China was really buying gold in this bear market, and effectively the market was cleaned out. So we moved from under $300, and then you got to the great financial crisis, at which time, ahead of that, it was around about $1,000. On the crisis, again, you had this Keynesian flight out of risk assets into cash dollars, which meant that the price of gold fell to something like 680. And then once that hiatus quietened down, it was off to the races up to about 1920. So you've got these sort of swings all the time. But I think now we've got to the stage where the confidence, if you like, in the paper currencies is being seriously undermined. everybody noted that the expansion of, if you like, of currency in circulation as a result of stimmies and all the rest of it over COVID, there's sort of thought, well, that's a one-off. But then suddenly it's not a one-off. We've got other things. We've got energy prices. We've got all these things. So there is another reason why you're going to get a debasement of the currency. And what happens is that there comes a point where people begin to see that that is going to continue and it's going to destroy the currency, or at least the currency is overvalued compared with those prospects. So it gets sold down first in the foreign exchanges, and generally the last people to really realize that the purchasing power of their currency is collapsing are its actual users, the domestic users of dollars, in your case, in America. They will be last to, as a cohort, to really understand this. And when they wake up to that, and they could wake up, I don't know, it could be quite quick, then they will dump dollars for anything. I mean, anything that they need, which they don't need now, but they might need in the future, just to get out of the currency. That's what Ludwig von Mises called the crack-up boom. It's that final thing. Everybody just trying to get the hell out of currencies and get into something tangible, something real. So I think that unless there is some miracle that happens, unless there is a proper recognition that that is our destiny, then I think it becomes inevitable.
Now, when it comes to the price action we're seeing in precious metals right now, it seems like the last couple of days we've been seeing a couple legs up, a good rally there. But we do have some people, still looking for gold to fall, possibly to the 1400s. Your perspective on this, Steve is wanting to know, does gold have another leg down this year due to US dollar strength, or is this the rally that we've been waiting for?
I have to say that in my long years of stockbroking, I have seen people be converted purely on the basis of a price action. So they see that they've probably sold out after a very big fall. They then see, probably after a period of time, they begin to see the price suddenly sort of starting to move up. And they think, oh, I better have some gold, or have some, your favorite equity, whatever it might be. But I'm going to wait for the price to come back a bit because it's run away very, very quickly. And, only the other day, silver was what? It was, $17. It's now $21. I mean, do I really buy it on top of a rally like that sort of thing? I think I'll wait for it to come back. They wait for it to come back. It might come back a little bit, but never enough for you to get in. And the result is that the next run up to $24, $25, you still haven't got any. The big mistake in this is to look at gold and silver as an investment. No, it is not an investment. You buy physical gold and physical silver, and eventually you will spend it. It is money. It is not an investment. And that's the way to look at it. Now, in that sense, the price is completely immaterial. Whether you buy silver, I don't know, $18, $21, $26, is immaterial. Because what you're doing is you're getting the hell out of fiat currencies. You're protecting yourself against the increasing likelihood of a collapse of the fiat currency system. And if you don't do that, then you'll probably regret it forever because, certainly if it happens, which, as I say, is looking increasingly likely, you will regret not buying silver at, 20, 30, 40, 50, whatever. Because actually, what's happening is it's not silver going up so much, but it's the fiat currency going through the floor. Get out of the fiat currency is really what you should be thinking, and do it that way around. So whether it pulls back or not is immaterial to the violence that we face in fiat currency markets.
And it seems like that's what we're seeing right now is a lot of people waking up and a lot of people rushing into precious metals, and also central banks doing this. You recently wrote in your latest article that, there are a lot of people standing for delivery on COMEX. 37 tons of gold have been stood for delivery. This was in September. And also you mentioned perhaps minor central banks are cleaning out the market of physical bullion. Can you expand on the kind of demand that we've been seeing? Obviously here at Miles Franklin, we've been seeing incredible demand, but looking at the COMEX, looking at what central banks have been doing, what are you seeing?
Well, it's exactly as you say. I mean, I think the World Gold Council reported that last month, something like 30 tons was, another 30 tons was acquired by a number of central banks. When you look at deliveries out of COMEX on Friday, it was 6 tons. I mean, we've never seen a number like that. There just isn't, there isn't the physical around in quantity. And of course, the other thing is that refiners have problems. And this, I think, really does apply to silver. They have problems because their costs are rising because of the energy situation. And as the energy situation rises, then what do? Well, the answer basically is they will refine the metals which give them the best margin. And that's not silver. So the shortage of silver, I think, gets worse as a result of this. As to why central banks are accumulating gold, it's for exactly the same reasons that ordinary people are. They realize that the fiat currency system is under threat. And it makes sense to have in your foreign reserves or in your national wealth fund or whatever it might be, it makes sense to have physical gold where there is no counterparty risk, as they would put it, instead of dollars, euros, yen, Uncle Tom Cobley and all. I mean, paper currencies are paper currencies. There's counterparty risk. And that counterparty risk, as far as the central banks are concerned, is escalating. The only central banks who do not appear to be adding to their holdings are the major central banks, like Japan, Britain, members of the Eurozone, and America. But in Asia, they very definitely are. And they're causing a huge, great shortage in the market. It's not just them. It's just, and of course, the correct way to look at it, as I keep on saying, is it's not gold or silver going up so much. It's more a question of the collapse of the utility of paper currencies. The confidence in them is evaporating. And we're seeing this at all levels, from central bankers all the way down to you and me, and people in the Eurozone, who see what's going on, and they think they don't really understand it, but they think, oh my goodness, this is this is very dangerous. Best thing to do is to have just a little bit of gold somewhere along the line. So they're doing exactly the same thing as the central banks, and this is spreading. The only guys who don't do this are the investment establishment, who, as I say, are basically Keynesian. And to be fair, they also have to account in dollars or account in sterling or account in euros or whatever. They run their portfolios measured in their fiat currencies. So for them to buy gold, I mean, they would probably do it with an ETF or something like that. Or if you're a hedge fund, they would probably do it, say, in the futures market, or maybe the forwards market. They see this, if you like, as a cost. Holding gold as a cost, they think. And so you get this sort of ridiculous situation where these people who actually don't understand investment. I mean, I know that they're running the investment establishment. They don't understand investment. They don't understand money. They just don't get it. And the fascinating thing is, if you look at the behavior of hedge funds in the managed money section, if you like, of COMEX, what do? They sell at the bottom and they buy at the top every time. And I remember when hedge funds first started hitting the scene, right, back in the early 90s, I remember the description. These were the new masters of the universe. I mean, for goodness sake, it's just crazy. They're not. They're idiots, absolute idiots. The people who are being sensible in this one are the people who are waking up to the fact that you've got to get out of, or you've got to hedge out of, the fiat currency system, price is immaterial. If you don't have the gold, if you don't have the silver, then you got a problem. And I think, everyone from central banks to individuals are beginning to see this.
And as you mentioned, price is immaterial. I think some people might think of that as, wait a second, I don't want to be buying at a high price. But at the end of the day, if you're buying it for wealth preservation and insurance, at the end of the day, does it matter how much you're paying for insurance? It's really that you have it. That's the important thing.
You're absolutely right. And, it's not an investment. That's the way you look at an investment. You buy, you go and buy your gold today at $1,728 in the hope that you can trade it out at $2,000 or whatever, whatever you think it's going to go to. So you're buying it to sell it. Yeah. No, that's an investment. But no, this is not the way to look at gold. You can do that with the futures market, yes, and go and get whipsawed along with all the hedge funds. But when it comes to physical gold is the only legal form of money. All the rest is credit. Everything else is credit. So have some money is really the way to get out of the fiat currency credit system, which is, in my view, at great risk of imploding.
We have one last viewer's question for you. This might be helpful if people want to be as well educated as you are. Do you have any book recommendations?
Oh, that's a difficult one. My book recommendations are, probably a bit esoteric. I think try and understand Austrian economics. It won't answer all your questions, but it'll at least get you out of this stupid Keynesian paradigm. Anything really. If you go to the Mises Institute, you can get a lot of these books for free. Download them as PDFs or ebooks or whatever. They've got a very, very extensive library. I would look at things by Mises. Mises can be quite hard to understand. Rothbard is good. He is less hard to understand. Hayek, obviously. So those are three names that I would throw at you. There is a very good book written by Hazlitt, which is Economics in One Easy Lesson. That's a good one. So I'd recommend that. Anyway, that's probably enough bedtime reading to be going on with. But I would go in that direction, and I would say that really what you've got to do is you've got to demolish in your own mind any validity of the Keynesian approach to economics. Keynes invented macroeconomics. Forget about statistics. You cannot manage an economy on statistics. I'm sorry, you can't actually manage an economy full stop. You should let people get on with their business. And Lord Macaulay, who was a brother of my however many great-grandfathers going back, he said, the business of everyone is the business of no one. And I think that is actually, the problem. Governments are making it their business to be, to be the business of everybody. They're just, it's just got to a crazy situation where we can no longer afford our governments. So there we are.
And if people are interested in reading your work, where can they find you?
Goldmoney.com, hit the research tab, and I do an article on Thursdays. The one I'm working on at the moment is slightly esoteric. It's actually defining credit, trying to, get people to understand that credit is a far wider problem than just bank credit. But that's on Thursdays, released round about midday to early afternoon EST. And I do a market report on Fridays at the same time. So that might be helpful to people, sort of trying to understand what the moment-to-moment dynamics behind the markets are.
All right. Well, we'll put a link to that in the description of this video, the research tab on the Gold Money website. Alasdair, once again, thank you so much for your time, as always.
That's my pleasure, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers.
Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty in Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.